Thank you once again for being with us, Hedieh.
Thanks a lot.
We
Thanks,
can see your
everyone.
screen.
Perfect. So thanks, everyone, for joining. Hi. So today I want to talk to you about this very interesting topic, which is the cash flow waterfall in a project finance transaction. And I just want to start by saying, this observation that I have, during the past couple of months about really thinking about what is the function of the financial model. Why do we use it? Because I've been preaching and talking about let's use this, let's not consider the financial model as just a document, a requirement by lenders, by other parties. Let's just use this financial model for our own analysis. If you're a sponsor, if you're a developer, or even if you're a lender, all the parties involved, if they can really understand the importance of this document, which is the financial model, which is up to now has been Excel based. And that's why I call it a document, because I think one of the qualities that the financial model should have is that it should really it should be telling the story. You should be able to read a financial model like you read any other project document. So it should be that clear. And that's why I've been stressing on the design and the layout of financial models all during the past years that I've been, working on this field. But recently I kind of understood or came to this realization that it's not just about the model design, it's also about a mindset, that we have to really understand it, and it comes with time. It comes with looking at different financial models. That's how you get this thing that when you open a financial model, you can really tell the story of the project by looking at it. And it's a very good skill to have, how to read financial statements. And they say that, Warren Buffett, one of his skills is that he can really read and understand financial statements. And in a project finance transaction, there are two statements that are very important. One is the sources and uses of funds that we use during construction. And the other one, which is like post-construction, is the cash flow waterfall. So first of all, why is this statement needed and why it was created? This is because of the nature of project finance, which is a non-recourse or limited recourse. So that's why the importance, you will understand that cash is very important. So lenders that are involved in a deal, what they want to make sure is that, of course, when you're looking at the world from the base case point of view, everything is rosy, everything works out, there is enough cash to pay the lenders, there is enough cash to fund the reserve account, and to pay the shareholders, and the shareholders can easily get their return that they require. So this is the story of the base case. However, when you apply a sensitivity and you just apply a shock, a down case, then you will see that that's when the discussion starts happening about what's going to happen if the base case doesn't happen. If we have a down case, then who's going to get the money, the money that is generated in the project account? Who's going to be the first one who's going to get their hands on these cash generated by the project? And that's why this cash flow waterfall was created, so that it tells that this pie, which is the project revenues, first of all, how is it going to be distributed? And then when. So the priority, the ranking is what makes the cash flow waterfall an important statement. So myself, how do I use a cash flow waterfall? I use it in two ways. So I'm just showing you one of my financial models now. So when I am building first a financial model, I use the cash flow waterfall as a roadmap for myself to build the different modules into my financial model. So I start with the revenues. So I have a revenue tab, which takes into account all the revenues and OPEX calculations. And then the other line in the cash flow waterfall is the OPEX. So I just build my OPEX line, I build my CAPEX, and this is gonna, I use it as a roadmap to building the different modules in my model. And then when I'm reviewing someone else's financial models, after I done the mechanical check, so I do it in phases. Phase one of my review is to check, the model mechanic. Once I'm comfortable with the model mechanic, I want to go straight into the inputs. But before that, I want to first understand the project and read the project. And that's why I come to the cash flow waterfall and I look at, each cash flow item. And what I want to maybe show you today is that if you just look at the financial model in terms of the cash in and cash out and money value, you don't get to feel, the story of what is happening in this project. If you just have, change your mindset and look at it from what are the actors, and then you will just see another side of the story by just looking at a financial statement. So for example, when I look at the cash flow waterfall here, I look at the revenue line. The first one is the source, we call it the source. It's so important. It's the source of our revenue. So the source of our cash, which is the revenue line. So first, I want to really understand this cash item, which is basically has two sides, is the price and it has the quantity. So I need to put my hat as a technical advisor and really understand what is happening in the quantity side of this calculation. And then I need to put the hat of a market analyst and understand the price side. So once I'm comfortable with these two, then I can come, really understand what is this revenue line, the source of my cash in this project. Then we have the OPEX item. So let me show you an extract, actually an actual term sheet, because you see this cash flow waterfall that we have in our financial model is a contractual thing. It's documented in the loan agreement with the lenders. So you also need to, as a financial modeler, as someone who's working on the financial model, you should also be able to understand the legal language and how this cash flow waterfall that you need to build in the model is formulated in the contracts. And maybe you as a financial modeler would also need to contribute, in drafting these kind of documents, because as you know, most of the things that are in the contracts are somehow included also in the financial model. So for example, in this term sheet, let me show you. In this term sheet that is coming from a real contract, you see that we have a section where, in the agreement, they are talking about the definitions. So they really define, these ranking of each cash out item in this cash flow waterfall. So for this example, and it's a very good example, I think, we have, first of all, we have all these different project accounts, right? During the development phase, before financial close, lenders require the project to establish these different accounts with a bank or with different banks, offshore and onshore. So lenders will really monitor these accounts and, make sure that these priorities are respected when it comes to cash out from the project accounts. So the first thing is that in this term sheet that I'm showing you here, they are giving priority. First is during availability period only, the project cost. We know that cash flow waterfall mainly talks about, it's contains, the discussions that will be around post-construction. As I said, during construction, we have this statement called sources and uses, and that is going to be the topic of discussion for the construction phase. all the drawdown schedules, who's going to draw down first, is it going to be equity first, debt first. So these are all the discussions that will be dealt with, in the sources and uses. However, with the cash flow waterfall, we start from this key date that is called the commercial operation date. So they say if there are any CapEx that are left after that, because availability periods, sometimes it goes beyond construction. If there are still any CapEx, the money first go to CapEx. Then the second of all is the government taxes. Of course, the project has to pay its taxes. So everybody understand that, these things that are ranked first are necessities, right? It's somehow the operation of the project, the existence of a project depends on them. So that's why they rank them first. And the second one is the tax. The third one is the operating costs. And this is when there will be a lot of discussions around what is included, because as you see, the ranking of these people or these contractors that are included in this project operating cost, they are ranked high, they are senior even to debt service, they are even senior to lenders. So we have to, you have to be able to justify that these, contractors, their services is really needed for the production of or generation of these revenues that we have as the source of income in this project. And as I said, the lenders will really monitor that. They really audit all these project costs, and they just want to make sure that there is no early dividends in these costs, you see. So for example, I remember, just to give you an example, in one of my projects, we had, with the team, we defined the breakdown of the operating cost, and we had a one cost item, which we called it management fees. And so we sent it to the lenders, and then they came back to us and they said management fees should not be included as part of the operating cost. It should be down, paid out as a dividend. But in reality, this cost item that we called management fee was actually, we had a contractor who was coming and providing a service. It was a financial service to get to get the project to this financial completion date. So all the financial modeling services and all that is needed for that phase was included in that contract. So we kind of send them, the justification and give them the explanation about, why this cost is, should be included as part of the OPEX, because it's a service that the project needs. So that's why when I talk about the review of models, I always say that, if you're reviewing someone else's model, just always, keep an open mind. And instead of, coming to conclusion first, kind of question it. Why do you have this cost item in the operating cost? Who is getting it? If you have any justification, please provide. So just, of course, we need to have this quality that I call financial model detective. We need to be very careful about, all these cost items and understand them. But however, we should always keep this open mind. So everybody is comfortable with the operating costs ranking higher, in the cash flow waterfall, and it makes sense. After that, right away, we have the fees. So now the lenders, so up to here, in terms of the financial model, we have reached this line called cash flow available for debt service, which is what the lenders use as their metric to size the debt, to calculate the different metrics, the debt metrics that they use is based on this cash flow available for debt service. So you understand the importance of this cash flow waterfall now, because everything, that the ranking that we put in the cash flow waterfall, there is the ingredients that will give us the metrics that the lenders use. So for me, a project finance model, the main output is this cash flow waterfall, and the byproducts are the metrics that we calculate, which are all coming from the cash flow waterfall statement. So now, after the ranking of the operating expenses, taxes, then we have the fees and the interest and the principal repayment to senior lenders, okay? So the senior lenders are the one that gets, the cash, after the operating expenses are paid and after the taxes are paid. And then after that, after we pay our debt service, then we have also the reserve accounts, the multiple reserve accounts that we need to have in a project finance transaction, like the debt service reserve account, the maintenance reserve account. So all of them, they are ranked after the senior debt service repayment. So the funding of these accounts, if they are funded, with cash from operation, then the funding of it has a ranking also in the cash flow waterfall. And if you're also backing it up by a letter of credit, an LC, then the fee that is related to that LC is also ranked lower than the debt service. But these are, some of these topics that, I will discuss later, they are still subject to negotiation. For example, this LC fee for the DSRA, I have seen it in, some projects that was actually included in the OPEX, but in some project it was subordinated and it was ranked, below even that service. So the ranking is important and is also, remember, because it defines this line that we call cash flow available for debt service. It also basically changes the calculation that we have or the ratios that we're going to present based on that, and the debt sizing as well. So all these things are very important to think about and also to see where there is any room for negotiation. And from the point of view, if you are the one building the model, you want to build it, the first draft at least, from your point of view, what's, works for you, and then send it, to other parties and then start negotiating based on that. So that's why it's important to know from which point of view you're looking, because it's going to be totally a different story if you're a lender, how you want this ranking, to be, and if you're a sponsor, is a different story. So these are important also things to think about when we go through a cash flow waterfall. So after the reserve account, then if there are any kind of junior facility or mezzanine facilities, then they are ranked, lower. So that's the difference that we have with the junior and the senior lenders, is basically that the junior lenders, they take a higher risk than the senior lenders, because they are big, actually subordinated to the senior lenders. So they are taking a higher risk, and that's why also they justify maybe the higher interest rate for their instruments. Then we have, after we pay all these lenders, after we pay the senior lenders, after we pay the reserve accounts, we fully fund all the reserve accounts and the junior lenders, then whatever remains can be paid to shareholders, okay, in any form. So how the shareholders handle the cash is their business, right? So if they want to get a shareholder loan, or if they want to put pure equity, this is their own kitchen, right? So the lenders, they don't have much power in deciding, as long as it makes sense, and as long as, they satisfy these different covenants, that the lenders put, they are free to distribute the cash however they want. So that's the concerns that the lenders they have, is up to where they are concerned, up to their ranking. After that, it's just not really their business. And of course, they still monitor the cash in and out by putting all the covenants, debt covenants and DSCR ratios, dividend lockups, and all these metrics that will block the cash in case things go wrong. So in a financial model, I showed you in one of my models. Please, if you have any question, don't hesitate to stop me. I don't know if you already have any questions or not, but please jump in and, let's just have an interactive discussion on this interesting topic. So this is the typical one. We saw the one in the term sheet. Now you see the same thing now in a financial model. In this sheet that I call, in my model, I call it IFS, Integrated Financial Statement, which contains the three main statements: cash flow waterfall, P&L and the balance sheet. So that's where I have my cash flow waterfall. And it's such an important, kind of statement that you want to also put maybe a summary, somewhere in your summary sheet, and you also make some dynamic charts so that people can go over these different lines that are important, like the cash flow available for debt service, and some summary of this cash flow statement is also a good practice to put it in your summary sheet and put some visuals as well. So what are the points of negotiation that we discussed? So first of all, as I said, this OPEX item is something that, when it comes to the waterfall, you really want to understand it. You really want to know who are these people that are ranked first. So when you receive a financial model and it contains only one line of OPEX, like per unit of production, and they use that in the assumption, this is not really acceptable because of this, the importance of these cash items. We need to really understand who they are, and then we need at least, a reasonable breakdown of these costs to be included in the financial model. So you might ask me, so Hedieh, why are you including your the CapEx as well in your cash flow waterfall? This you told me that you have already dealt with in the sources and uses of funds statement. That's correct. I don't need to really, when I come to the cash flow waterfall, I don't really need to go and look at the construction, because the ranking and all that, as we said, it's not really a concern at the construction phase. The construction phase, you have a schedule for all your cost items, and you have a drawdown schedule as well. So the priorities, is not something that is discussed. It is basically set by the contracts and, by the schedules and the budgets that we have. So the ranking, the importance of ranking comes post-construction. However, it's a good practice to put it, first of all, because I like to use one single timeline in all my calculation sheet. So I don't have, one timeline which is, on monthly, and then another one which is on semi-annual. I would like to keep one single timeline in all my models. So this single timeline, I have used it during my construction, which I have the flexibility to build it on monthly during construction. And when I come to my operation, I'm going to switch to semi-annually. Yes, this is the case, then it's going to be switched to semi-annually. So that's the reason why I want to also include the CapEx and also the drawdown on the different instruments in my cash flow waterfall as well. And it's also another check, because during construction, you should not have any shortfall, right, in your sources and uses. So it's a double check, because you have already included a check when you do your financing and you do your sources and uses of fund, you already have a check in your model to make sure that the sources and uses, they match. You see, so you have that check. However, it's good to also do a double check here as well in this in the cash flow waterfall statement, to make sure that, as you can see here, it's all zero. So it means that I don't have any shortfall during my construction. And another check that you want to include, in the cash flow waterfall, is to make sure that you don't have also any shortfall post construction. In any periods in the model, you should not have any shortfall. And if you have a shortfall, maybe it's because, you can justify the sensitivity that you have run, you have decreased your revenue, so now this scenario is not working. So the model will flag it by using this error check in the model, or sanity check, to make sure that you don't have any shortfall during any period in the model in the cash flow waterfall. So if you don't have any question, I think we do have one question that I want to also spend some time discussing about what are the points of negotiation regarding this cash flow waterfall.
Yeah, I think there are two questions at the moment,
Sure.
Hedieh. If you want to
Mhm.
take a look at the chat, or I'm happy to read them
Sure.
out for you, whatever's easier.
Sure, I can see one there.
One from Abdullah,
Yes.
who is asking, is it common to include initial working capital investment into the project costs?
Working capital investment. Okay. Exactly. Yes, perfect question. So, because I don't know if it is clear to everyone. I think the question is because you see, when you come to, let me come to my first operating year. This is the first semester that I'm starting operation. Visually, we can also graph it, but let's leave it. You see that here, this is the cash received from operation. So I have already adjusted this line for the working capital impact, right? Because when I'm sending the invoice, in this case, it's a power project. So I'm sending my invoice to the utility to pay me for the 6 months of generation that I had. I give them, based on the power purchase agreements that I have with the utility. Utility has given me 45 days. I have given 45 days to the utility to pay me back, right? So within these 45 days, I don't receive any revenues, right? So I need to make this adjustment. So the question is, because I don't have, the maximum, the full cash in this first operating year, shall I pre-fund it and put it as a project cost so that I make sure that, I have enough funds to secure for all my expenses? And yes, that's something very common. We call it in the project cost. Let me see if I have it in this model. In the breakdown, pre-funded working capital, exactly. So as you can see here in this project as well, we have 1.9 million, which is pre-funded in the working capital. So in the last months of construction, they will set up this account and they're going to put this money in this account and lock it and release it in the first operating year when, the cash is needed. For the amount, so that's also another topic of discussion among lenders and sponsors. How are we going to size this pre-funding or working capital? It's common to use X months of operating expenses, sometimes including interest as well, that will be in this account. Or you do it exactly, you do the pre-funded working capital by looking at the difference between the revenues and the operating costs that you have. So there are different methods to calculate this pre-funding of working capital, but that's definitely a contingency that is required and is good to have in the budget, in the construction budget.
Thank you, Hedieh. A few more questions that have come through.
Sure.
Do you want to leave them towards the end, or should I read the current ones and then we move?
Yeah, sure. Let's go through them.
Okay, so Marcelo is asking whether there are any templates for a cash flow statement that you can use as a starting point in your financial models. He understands that there are lines that may not apply to every project, but is there anything that people can use just to start?
Exactly, yes. So I have a template that I can share with you that with a kind of a write-up as well, explaining these things that we are also discussing here. So I'll be sharing it and you can have an example of a typical cash flow waterfall, yeah, sure. That can be shared.
Thank you, Hedieh. Question from Bupati. How to handle 45-day accounts receivable in a monthly model?
So that's a very technical kind of discussion. I think, maybe we can discuss it later, but these days because I've been shifting my point of view to building monthly models, even during operation, because I've been insisting, to have construction on monthly basis always. But nowadays, although I was against it, but I think I'm converting to, building also operation on monthly basis. So all these topics are very interesting topics and we can have a separate discussion on them. But sure, yeah.
Thank you, Hedieh. Ellie is asking, can you show us the working capital calculation in the model? And just a follow-up question is whether you can share that the file that you're currently using with the audience afterwards.
Sure. It's a very simple template I have for a solar project. So it doesn't have the really complicated stuff like debt sizing and all that, but I can share it with you, sure.
Thank you. And yeah, the second question was, can you show us the working capital calculation in the model?
Yeah, sure. Let's go there. So this is the sheet I call revenue and OPEX. So I do all my revenue calculation, and then I have my account receivable. I put it, just right after I do my revenue calculation. Then I just compute, this very simple calculation for this. Here I had a 30 days receivable. So the actual revenues that I will claim during the 6 months is 21 million. But because of these 30 days, the actual receivable is 19 million, right? So the difference is what I don't receive, right, is the 1.7 million. At the same time, I have also some in my operating expenses, I also have, my accounts payable. So how many days I have? 30 days as well. So I can just delay paying my invoices also 30 days. So I will also take that into account. But as you can see, the accounts receivable is much more significant than my account payable. And that's what justifies having this pre-funding of working capital. And then the rest is just, a simple account that you create, but you want to make sure that at the end of the life of the project, the balance of this account goes to zero. Okay.
Thank you.
Welcome. So now I want to maybe, also talk about these. So we talked about, it's an obligation, it's a contractual obligation, and we saw also the legal language, which was also important to see. Now I want to talk about, the common points of negotiation that I have saw, when it comes to the cash flow waterfall. First of all, we talked about management fees that, in the OPEX. So when you're reviewing a model in the operating expenses, you want to make sure that there are no early dividends, and all the contractors and anybody who gets paid at that stage under the operating cost is actually providing a service that is necessary for the project. If it is just if it is just a management fee, it should be really subordinated. Then we have insurance fee for equity. That has been really a topic of discussion that I have seen a lot of, discussion around this. When developers, sponsors, they come and invest in a country that maybe they consider like not really politically risky and not secured. So they want to get some products that can secure their equity, right? Political risk insurance and different kind of insurance products. So now the discussion will be, there are some these fees, who is going to pay for that, right? So as a sponsor, you want to claim them as a project cost, right? You want to include them maybe under the OPEX, or it should be a project cost. This is from the point of view of the sponsor, that will benefit them, right, to pay it out of the project costs. However, lenders somehow, they have a different point of view. They say this is something that you want to get for equity. It is your own kitchen. You want to secure your equity. So this should be paid out, not only out of your dividend, but it should not even be a project cost. So you pay it at your company level, not at the SPV level, okay? But then the question remains, what about during construction? So during construction, I don't have any revenues as a sponsor. So how am I going to pay for that? And in most cases, lender accepts for these fees to be included, in the budget, in the construction budgets during construction. But when it comes to operation, that's why I sometimes put a switch in my model. to have this fee included as part of the project cost, or to be paid out directly from the dividend. So if it is paid out of the project cost, it will show up in my financial model, in my statements. If it is not, then it will only appear in the equity IRR calculation. So when I do my equity IRR calculation, I need to deduct, this cost and show the return, after I include this payment of this fee, insurance fees. And the same thing also applies for the LC fees for different kind of the equity obligation, because you know that there are different kind of requirements by lenders for the sponsors to provide some kind of contingent equity. So there is one part of equity that is like funded equity, which is cash equity that they need to contribute during construction to fund the construction cost. And the lenders, they require that because also they want to have a skin in the game, from these sponsors in the project. So they are committed and they have an incentive, to take the project to completion. And there is also a part that is unfunded contingent equity. And sometimes these contingent equity, you can just, back it up by an LC. So the LC fees, also there's a discussion, who pays for it? Can it be included in the project cost or not? So these are also some, discussions that will be between lenders and sponsors. The other thing that I saw an interesting discussion is the funding and the release from debt service reserve account. So definitely funding of the debt service reserve account would be subordinated to OPEX and, debt service, meaning interest and principal repayments. However, the release from it is an interesting discussion, to have. What about the release? Can we include the release from the debt service reserve account in the definition of the cash flow waterfall? And how do we benefit? How does the project benefit from that? Is that if you include the release from this account in the definition of the cash flow available for debt service, then if you do your debt sizing based on cash flow available for debt service, you will increase the debt service capacity of the project, so you can raise more debt. So that's why it's also, in terms of modeling, I can tell you it's a nightmare if you want to do that. It's a circularity that is very difficult to deal with. So the only solution that I have seen people only one person using, which is Professor Edward Bodmer, is to use a user-defined function to go around this circularity. But it's an interesting, discussion to think about including the release inside the definition of the cash flow available for debt service. And the same thing for the maintenance reserve account. So just to give you an indication that these are the points that you can still negotiate, and this is not, something that is, kind of like, it's still, I have seen different versions in different projects. For example, maintenance reserve account, the funding of the maintenance reserve account in almost 100% of the project has been subordinated to the funding of the debt service reserve account. But to me, it was always like, it didn't make sense to me. Maintenance, to me, it should be priority to debt service even. But anyways, that's lenders, they require for the maintenance reserve account. I don't know, maybe you had a different experience and you can share, but what I have seen is that it is subordinated to debt service reserve accounts. And yes, so that's the main things that I wanted to cover. I don't know if there is anything else that you want to raise, or if you already have any other additional things to discuss. Yes, I see we have a question from Marcello there, right?
Yes, we do. What has been your experience with the developer premium fees milestone payments? I assume they're quite similar to management fees, but one could also argue they are a necessity to make a project feasible.
very good question. I mean, I worked, I had the privilege to work, for a couple of years, for as lenders from the lender side, and then also from the sponsor side. And when I was working, for lenders and for the African Development Bank, we were always, considering these development fees as, evil, and these sponsors, they want to get, these fees, why do they want these fees? But then when I worked, as for a developer, then I saw, that these people, they're people who are putting their money, and they are really, taking a high risk during this development phase, basically the only thing that these people have, I always say these people are visionaries. They only have a vision. They are just, following their vision. There is nothing concrete in project finance, especially at that stage. You don't have anything. It's just promises. It's just contracts. That's why lawyers, they play such an important role in a project finance transaction, because everything is around these these contracts, which are embedded, in clauses and everything. So the lawyers, they put together all these securities. And so development fee is really something that is a real cost. It's the real remuneration. These people, they have put their own money, they have put their own time, they have actually paid advisors, all these advisors, legal, technical, tax, financial model audit, they have actually paid all this cost. They are real costs, it's not just time cost of some individuals, it's real cost that they have paid. And on top of that, they need to be remunerated for the effort that they have put and for the cost of capital, this money. I worked mainly for projects in Africa and the development phase of these projects in Africa, and it's so unfortunate that it's very long, and that's what makes the projects very expensive. Because so what is happening is that once you negotiate with the lenders, the developers, they give their cost, the accounts, what they have paid, and they have to put all the evidence of all the invoices to the lenders, and the lenders, they will audit this cost. They will check this cost, and they make sure that they are real costs. And after they say, okay, we accept from out of your 10 million costs, we accept 9 million of it, 9.3 million of it is actual project cost. So we can put that as actual project cost in the budget. So they will be reimbursed, right, as equity. It's equity. So either the sponsors who come post financial close, they either paid the developer and bought the shares from the developer, and now they are working, as equity and sponsors during construction, or is the same developer, they developed the project and now they are continuing, as equity, as sponsors during construction. In both cases, these people, these entities, developers, they need to be remunerated. Then the discussion on how much should they be remunerated is another discussion, that's what is fair or what is not fair. And you can, the developers, they need to justify, to show that exactly, sometimes they get a loan even to fund, so they have actual cost of capital for their expenses. So yes, it varies from project to project, but it's always a topic of discussion of what should be the premium that can be accepted as part of the project cost.
Thank you, Hedieh. Marcelo saying thank you as well. Question from Mridu. Sorry if I'm not pronouncing the name correctly. Do lenders allow to include DSRA and MMRA in project costs?
Perfect, thanks. Yeah, so actually these are, both of them are requirement from lenders. It's the lenders who are imposing. Sponsors, they have no interest to put some money aside under the debt service reserve account, because it's a contingency for lenders. They say, you need to, every 6 months, we're going to monitor this account. You have to look forward for the next 12 months, next 6 months, and, put that money aside equivalent to 6 months of interest and principal, trap it in the cash account. So you will not be able to pay it out as dividend. You need to trap it and then release it, if, you compare it with the next upcoming debt service, and you can release, the difference. And you see, that's how you also model it in Excel. By understanding it, you see that it's very easy to actually model as well. So that's a requirement by lenders. So that's why they make sure that in terms of seniority, the funding of this account comes right after that service, to make sure that they have these contingencies sitting, in this account in case things go wrong. And the same thing for major maintenance. If you have for example, a solar project, like with batteries, or like even the inverters, you have to replace them every 5 years, every 10 years. And it's like a CapEx item, it's like sometimes 5 million, 10 million that you need to pay at some point, in 1 year. So the lenders, they want to make sure that you don't have that cost, that chunk somewhere down the road. So they want to kind of smooth it out so that by the time the project reaches that date, that milestone date that they need to do these maintenance costs, the money is already in the account. So they will release it to pay for these costs. So
you
definitely
said they need to be included as part of the project costs, because this
exactly yes, it should be included, and it should be also included in the financial model. Because of the mechanic of the maintenance reserve account, if you really understand it, it's turning this CapEx item, which is a big chunk, as I said, 10 million, 5 million in year 10, is smoothing it out. It's making it like an OPEX. So I see some models that they put the funding of the major maintenance account in the OPEX item. And that's something that I always object. First of all, because financial model is a contractual document as well. So you've seen the cash flow waterfall that I showed you, the example. The major maintenance reserve account in terms of ranking comes, after, debt service and after. So it has a ranking. It's documented in this legal document that the ranking is there. So the model should actually reflect what is in the contract. So although in terms of the modeling, it has the same impact as putting it as an OPEX item. However, just to make it sure that the loan agreement matches with the financial model, you should also bring that mechanics into the model as well.
Very well explained. Thank you, Hedieh. Srini is asking, certain projects require major maintenance and replacement CapEx on an annual basis. Can we attach priority to this over the debt repayments?
You see, the funding, I mean, these actual CapEx items, yes, they are actually senior to debt service. The CapEx item, yes, it is in the cash flow waterfall. It comes as the same ranking as OPEX. However, because you're funding it with the reserve account, you basically cancel them. You know what I mean? In terms of the financial model, it's an in and it's an out, because you have already funded that, with this reserve account. You have smoothed it out, this cost item, so that when you get to that year when you need to pay for that CapEx, you cancel the cost item with the release from the reserve account, you see? So that's why in terms of priority, yes, it is senior to debt service. But then, it's in terms of the impact, because we have this major maintenance reserve account, and that's why the lenders, they want to make sure that this account is there, is to make sure that we don't have this chunk of, this high cost somewhere, because it's senior to their repayments.
Great.
I don't know if that was the question.
I think so. You guys are also welcome to turn on your cameras if you want to ask Hedieh something on screen. That's okay, sure, as well. Next question is from Mridu. What exactly do developers prefer, the management fee reimbursement or dividends, from what you've seen?
Well, I mean, yes, it's an interesting question, but I mean, just look at it from this point of view. The developer, they have been there, they have started, I mean, to give you a real example, I have worked on a project which we started in 2013, and we closed it here in 2023, hydro project. So these people, they have worked, all these years to develop this project. So if they want to wait also for the construction to finish and they take the risk, because if you're involved as a shareholder and you have a share in the project company, that's what dividend means. You have an economic share, right? So if a developer comes and say, give me, they call it free carry, instead of they give them a economic share in the project. But so it's free carry because they don't put equity. It's the remuneration for the development cost that they have put. But for that, the developer needs to take the construction risk and also wait, I don't know, for a hydro project, 3 years, 5 years for the project to finish, and then get their dividend. So of course they prefer to have, a remuneration at financial close. At this stage, that's when that is more like common, that you pay, the premium to the developer when you close the project. And sometimes also it's a point of negotiation. Lenders sometimes say you cannot pay it fully at financial close. You need to pay 50% at financial close, another milestone, and then another one at the end, and then maybe even another one at financial completion date, which falls after commercial operation date. But this is something that is very painful for a developer. They would rather, get their remuneration right at financial close, because that's how they get their return. So yes, but if it is a shareholder that comes in at, at some later stage of development, then, a free carry might also do. So they might also accept, or if they are really interested in, continuing with the project, they might accept a share as fees, premiumed, and another share as free carry, a combination of both of them. So these are all the different structures that the developer negotiate at the JDA stage.
Great. Question from Jeremy. As a lender point of view, should it be better to negotiate with the developer to fund the DSRA, or to use a letter of credit instead?
Mm-hmm. From the lender's point of view, right? Yes, exactly. Yes. So from the lender's point of view, I don't think it makes any difference, right? It should not make any difference for them, because the letter of credit also tells them, the cash is available there. However, from the sponsor's point of view, maybe it's better not to have the cash trapped, in the and then be able to release it. So from the lender's point of view, they should not really object. Sponsors, they mainly prefer to have the LC, but from the lender's point of view, they should not really object whether it's pre-funded or it's funded with an LC. It should not really make any difference to them. But yeah, so that was my experience, that they were okay with both. So it was just a choice for the sponsors to decide how they want to fund it.
I do have a question. I don't know if I can do it through here.
Yeah, of course. Go ahead.
Just two questions, let's say, on the personal modeling preference, right? Is the cash flow statement your usual go-to segment of a financial model to check when you receive a new model, let's say from an external party, or do you go to the project IRR, equity IRR calculation, just, at a first glance to quickly check, is that the one that you go to, or do you actually go to the operational EBITDA calculation, or yeah, that's just the first one. And the second one is, do you have any regular checks that you do on the cash flow statement? And maybe that's based on the first question on your template, meaning I know that probably if you have a negative, you have a check in there to see you have in this period negative, but is there others that you use to sort of save time in checking just cash flow statement, particularly in this month by month that you were mentioning?
Yeah, sure. So on the review, actually we will have a session tomorrow as well on the review of financial models with the PFI, I guess. But yeah, so on the financial model, let me go to my model. So what I do, I told you, I do I do my review in 2 phases. Phase 1, and I always tell my clients or my team, that's how I proceed. First, I do a mechanical check. I just want to make sure that this model is suitable for this project and has the quality that we want to carry this project forward into the next phase. Okay, not only this phase, but also to the next phase. So doing all the checks that you're all familiar with, to make sure that the models are flexible, they are simple, they are transparent, and all these things. So by the time that I decide that, I want to work with this model, I'm already comfortable with the model mechanic, okay? And then my next phase is to understand the story of this project, right? So I would definitely check the inputs, right? Inputs that's where I find my the story. The story is within the inputs. But for me, I mean, in my mindset, the way my mind works, I like to go to the cash flow waterfall and, just, do like, that's exactly how I do it. I just, put a chart and, graph it and see how my, each line item in my cash flow waterfall looks. So if I see that, there is actually, it's very good that you pointed out, because I wanted to show you something else that might be another topic of discussion as well, but it's how to convert this cash flow waterfall into what I call the sources and uses of funds during construction, during operation. So yeah, so I think it's a good statement to understand the story of the project. As I told you, not only looking at it from the cash perspective, but looking at it from the actors that are involved in this project. And you can really see it from the cash flow waterfall. You can see the OPEX items. First of all, you see the revenue lines. You need to understand, as I told you, the price and the quantity. So I go and I check the revenue sheet and I understand, what are the inputs, what are the outputs, why there are seasonalities, why is there any inflation, and just do my review based on that. Then I go to my operating expenses and this line and I graph it and I see how how it looks like, and then I will go into the details. So that's how I do my review to understand fully a project. That's what I do using the financial model, and it's a back and forth between the financial model and all the project documents, of course. But yeah, before, I don't know if I have answered it, but I just, quickly, I wanted to show you something before I will leave. So this is the actual project. I started in my models to include what I call sources and uses during operation, which is nothing but basically rearranging this cash flow waterfall into sources and uses, right? So it's a very interesting statement, which everybody that I presented my model in that, in that way, they really liked the idea. For example, here you see I have a chart which is showing the different components of my tariff. It's a solar project. So I have, as you can see in the red burgundy color, is the debt component, and I have the equity component, and I have the OPEX component. So here I broken down the ranking. So I don't care about the ranking anymore. I just took the inflows, as my revenue line, and then the outflows are all these, and I categorize them into three. One is debt service, one is taxes, and one is the, we can have taxes separately as well, but I put operating expenses, and we have the equity component. So if you take your cash flow waterfall and rearrange it, you will see that you can get a very interesting statement, which I call sources and uses of funds during operation. And if you divide those dollar amount, euro amount, whatever amount by your quantity, in my example, it was the kilowatt hours of production, then you get the tariff, because that's basically what a tariff is. A tariff is the amount, it's a gold stick of how much money you need in order to pay for all your expenses, right? So that's basically it. And that's why in terms of checks, I remember somebody asked for the checks. In terms of checks, this check in the cash flow waterfall is basically making sure that you don't have any negative retained cash balance. What does that mean? What does that mean if you have a negative, what does that mean? Here I have a positive, which is a surplus, which is just, a reserve account. But if I had a negative, it means that this line, which is my revenue, was not sufficient to pay for my users, for all the people that I have to pay. So there is something wrong. So it means that the sources and the users, they do not match, right? So that's something to think about for you as well. If you have a cash flow waterfall, think about just reformatting it into the sources and users, and you will have another statement that can tell you also other stories.
Amazing. Thank you, Hedieh. Well, I think that this now wraps things up very nicely. I will add Hedieh's book link once again. It's all about reviewing financial models, so I'm sure some of the questions have been related to that. So you guys will probably find it very useful. I confirm that the session is recorded. It will be available in the Project Finance Institute community within the next 24 hours for all of our members. And we will be sharing. Hedieh has kindly agreed to share this file, so we'll add it under the recording. And Hedieh, if you have any other cash flow statement templates that people can use as a starting point, that would be very useful to add as well. And yeah, thank you very much for joining us today. Thank you, Hedieh, once again.
Thank you.
It's always great to have you with us. And I will see you guys soon.
Thank you. Thanks, everyone. Thanks, Thea.
Thanks, guys.
Sorry, Thea. Just before you go, are we gonna have a next session, or this is the only and last?
Sorry, Ali.
I say, is this the only and last session with Hedieh, or are we gonna have any another upcoming session?
So this is the last session with Hedieh for Project Finance Institute members, unless you're part of the CPFA cohort.
Yes.
So if you're doing the Certified Project Finance Analyst course, which we run 3 times a year, then yeah, I think that you have a session with Hedieh tomorrow then, right, Hedieh?
Yes, yeah. Exactly,
so
yes.
Tomorrow you'll be going into more details on reviewing models, right?
Exactly, yes.
Thank you.
Amazing.
Thanks, everyone. Thanks,
guys.
That's great.
Bye-bye.
Thank you. Bye-bye.